if they add one extra 25 pip hike, which is already priced, that's not going to break anything, right? So I think for the equity market to be quite relaxed about what's coming, I think that's fair. I think that's all we think that's going to happen in today's dot plot, actually, yeah. So what's been an interesting pattern in the SEP, the Summary of Economic Projections, is that for the last year, the Fed's median dot perfectly follows their inflation projection. So they keep the real Fed funds rate constant at about 1.5%. So if today they lift the inflation forecast by 25 or 30 bips, then the dots will move 25 bips, and that's all you're going to get. And so we think that's then obviously July. And so if that's all that's priced in, that hasn't really changed the outlook.
Okay. What could upset the markets?
Doing more than that. So, I mean, if they basically lift their inflation forecast by a quarter point, but then lift the median dot by more than that, that's a change in reaction function relative to what we've seen in the last three SEPs. And so it'd be quite odd for them to do that because we know that inflation is going to step down with the next print by about 20 basis points, right? So we're going into a whole sequence of inflation prints which are going to be much lower than what we saw yesterday. We also, I think, you can't see it in the headline, but you certainly see the labor market starting to soften. The rents are behaving exactly in line with the model. They have a lot of, I think, confidence that they're going to land at something in rents that's 500 basis points lower than where they are now. So there's no reason to sort of escalate things right now, right? I think what the market is pricing makes a lot of sense, that you weren't quite sure whether you'd gone far enough, so maybe you add one. I think the bank lending stress is a little bit less bad than they feared, and that's sort of it, right? So that's all you deliver.
How confident are you in your call for the first cut from the Fed in December, and sort of what ducks need to all line up for that to happen? Because, you know, sitting at altitude, cruising speed, you know, higher for longer is one thing, but an actual cut is another.
Yeah, so if it's correct, the question, if it's correct that they're managing the real Fed funds rate and they do not want to become too restrictive, then the first cut is really a disinflation cut, right? So they have cuts in their own forecast except next year, right? So when inflation falls 100 basis points next year, they cut 100 basis points. We think we're going to get more disinflation by the end of the year, right? And so if that materializes, then they can start to reverse the excess tightening. That doesn't require them to abandon the high for longer narrative or, you know, basically invoke memories of sort of Arthur Burns and things like that, right? So all that needs to happen is get a little bit more disinflation than they expect. To get the cuts that we have in the forecast next year requires a recession, right? So we have significantly more than what the market is pricing. They're going to do a whole sequence of 50s if they go into recession. And on that one, I think the verdict is out. I mean, I think that the data is obviously very, very mixed. That's why the equity market is partly behaving the way it's behaving. But so if you get a mandate conflict, then the entire reaction function changes.